Marhaban, Assalamualaikum warahmatullahi wabarakatuh. A very good morning. Welcome to EQ112 lecture for week 8. I'm going to discuss a new topic that is about partnership, formation, operation, and reporting. There are three elements that I'm going to cover today: formation, operation, and reporting. So I'm using this PowerPoint from accounting textbook, 10 editions, yeah, by Hoggart that is published by John Wiley and Son Australia. So what are the things that I'm going to cover today? First, I'm going to define what is partnership, what are the major attributes, characteristic of partnership, okay, and what are the advantages as well as might be the advantages, indirectly the advantages of partnership. Explain what is the purpose of partnership agreement. If you run the sole proprietor, you don't need agreement to yourself, but when you deal with your colleagues or friend, you must have some agreements. Okay. Describe the special features applicable to accounting for partnership, how we account for the capitals, for the drawing, for the interest, yeah, on capital or interest on drawing. It might be different compared to the sole proprietorship. Explain the accounting entries in order to form the partnership. Explain the accounting entries for allocation of profit. When the company, sorry, when the partnership make profits, we need to divide the profit to partners. So what are the formula that we're going to use? How to record to the journal entries about the allocation of profit. Explain the accounting entries for drawings and advance or loan made by partners. Yeah, it's normal. Sometimes you have loans or drawing from partners. Yeah, and uh, and also describe the content of the financial statement of partnership. Not much different compared to the sole proprietorship. We still have statement of profit and loss or income statement, statement of changes in equity, and also the balance sheet. But there might be some element added there to distinguish between the capital owned by each individual partners. So for sole proprietorship, the owner of the business is what we call as the owner of the business for sole proprietorship. But for partnership, the owner of the business is called as partners. We have two or more partners. That's the difference, yeah, for partnerships. For companies or corporation, the owner of the business is known as shareholders or stockholders. In US, they call it stockholders. In other parts of the world, we call it as shareholders. So just a simple introduction. For sole proprietorship, for sole proprietorship, the owner of the business is known as owner, whereby for partnership, the owner is called as partners. For corporation or company, the owner of the business is called as shareholders, or maybe in some countries like US, they call it as stockholders. So the partnership acts for every country, they have this act, especially the common law countries. The relationship that subsists between person carrying on business in common with a view to profit. So two or more people, they sit down and discuss. Okay, they decided to form a partnership, to start a business together. They share the capital. They have a common vision that this business objective is to make profit. So there are three attributes that are necessary. There must be agreement, whether it's verbal or written. But I would like to suggest every one of you, if you want to form a partnership business, please come up with a written agreement. Okay. The business must be operated with a view to earn profit, to make profit. Yeah, every business, the aim of the business is to make profit. You cannot form a business that with objective to do charity works. Yeah, membership must be co-owners. Members must be the co-owners of the business. Members must be the co-owners of the business. So every partners must contribute capital, a sum of money, capital to the business. So what are the advantages of having this partnership compared to the sole proprietorship? Number one, it permits the pooling of both capital resources. If you run sole proprietorship, your capital is limited. You might only have 1 million. or you might have 100,000 dirham or dollar. When you combine your capital with your colleague, when you combine your capital with your colleague, for example, Mr. A contribute 100,000, his friend Mr. B contribute another 100,000. So we have extra capital now. If you have 10 partners, your capital will be much bigger. So that is the number one advantage of partnership. We have pooling of capital, and not only capital, but also other resources, skill, talent, and so on. So if you are from accounting or finance, you have your partners from engineering, from IT, from marketing. So you have also pool of talent, skill, yeah, and experience. Number two is easier and less costly to establish than a company. The cost of setting up a partnership is much lower compared to a company, and the regulation also not as strict as for companies. Okay, so partners may be able to operate with more flexibility because they are not subject to the control of a board of directors or to the external shareholders. For the company, they have this board of directors. Board of directors were appointed by the shareholders during the annual general meeting. So in the partnership, the partners run the business. And there are also some tax advantages given to the partnership business. So these are among the advantages of having partnership compared to the sole proprietorship or corporations. Okay. Let us move to the next one. What are the characteristics? What are the attributes of a partnership? Number one, the prospective owner of business should consider the tax and legal aspect of various structural form of business carefully before selecting the one that meet their goals and objective. Every country, even every emirates, every area, we have a tax-free area, so they might have different tax rule on that. So you must look at this matter before you decide whether you're going to establish a partnership business, corporation, or sole proprietorship. The partnership form may turn out to be unattractive because of the following characteristic, yeah, because of the tax factor and so on. Okay. Number one is, let us look at these several characteristics of partnership. Number one is mutual agency. What does it mean by mutual agency? It means that each partner, each person who contribute capital act as agent for the partnership or for every other partner. So this is what called as mutual agency. Everybody is agent for the business. So we have five partners. So we have five agents who are responsible to look after the business. Second is unlimited liability. Liability is obligation. Unlimited mean the partner's liability is not limited to the amount contributed by them. If, for example, partner A contributed 100,000 to the business, his liability is not up to the 100,000. In case of loan, default, or whatever, the liability can be more than that. If the partnership fail to serve that loan, to pay its loan, so the partners must use their own money to settle the liability of the partnership business. So this is what I mean as unlimited liability. For a company, if you invest 100,000 in company A, for example, then the company goes bankrupt, not able to pay loan, so your loss is only up to the amount invested, that is 100,000. The third party will not have a legal right to sue you for any unpaid balances compared to the partnership. Compared to the partnership. Next one is limited life. Limited life. Yeah. Yeah, human being has limited lives. For partnership also, it's subject to limited life. When, for example, death of partner, one of the partner died, for example, so we have to close the business. So that is the challenge of the partnership. Unless you're going to add more new partners, maybe is sons or daughter to be the new partners. But normally what happens is the death of partner will result in dissolution of the partnership business. About transfer of partnership interest, a capital interest in a partnership is a personal asset and individual partner that can be sold or disposed of legally. So this is about the interest or the capital in a partnership. Okay. Next, I move to partnership agreements because we are dealing with different parties. So you need to have specific agreement, what you agree on. Yeah, we need to know who's going to run the business. Yeah, how we're going to divide the profits. What if the partners take money out, for example, for drawing or loans? How are we going to handle that? How much interest we're going to charge? So all these things must be clearly, explicitly stated in the partnership agreement. So a partnership is a voluntary association based on the contractual agreement between legally competent people. So the contract is called as partnership agreement. Partnership agreement. In case any dispute between partners, they're not happy with each other, they got into fight. So we have to go back to the agreement and see what are the provision, yeah, agreed in the agreement. Yeah. So the partnership agreement should explicitly mention this. Number one is the partnership name, identify the partners, the nature of the business. For example, you're going to set up an IT business at Dubai Mall. Yeah. Location of the place of business, where is the location? Yeah. The premise, how profit and share losses are to be shared. Are you going to share it equally? Equally, you have three partners. Are you going to share one third, and one third? Or are you going to base on your proportion of the profit, the percentage of capital, maybe the percentage of the capital? Okay. Or so these are the things must be clearly stated in the partnership agreement. And authority or power of each partner in contractual situations. So what are the responsibility and power of them? How the withdrawal of asset by partner is to be handled. Withdrawal of assets, how are you going to record it? Conduct of the partnership affairs and how day-to-day operation to be conducted. We have maybe five partners. We have five partners. All these partners going to work at the business, or maybe you might have also sleeping partner. What is sleeping partner? They provide the capital, but they don't do anything. This is sleeping partner. We have active partner. We also have sleeping partner. Like in your group project, you will have sleeping partner as well as the active partner. Yeah. So how are we going to reward? Are we going to reward equally the sleeping partner and the active partner, or are we going to give special incentive to the to the active partners? How are we going to pay them? So most partnership are not a reporting entity and hence do not comply with accounting standard. So a major difference in account is accounting for partners' equity. So this is the main difference, that is about equity or capitals. Yeah, for sole proprietor, we only have one equity accounts, but for partnership, we have many partners' equity accounts, depending on the number of. In an ownership, interests are generally not equal because the capital investment and drawing of each partner vary over time. You have this partner A. Partner A contribute capital maybe 100,000. Partner B contribute 50,000. Partner C contribute 10,000. So this is the capital contributed by the partner. Maybe partner D contribute 200,000 capital. So the capital varies. So how are you going to give a reward to your partners? It must be vary as well. So if you give reward, for example, 10% on the capital, it should be 10% on the outstanding capital or opening capital for the business. Same goes to the profit. The profit and loss reported each accounting period is distributed to the partners in accordance with the partnership agreement. For example, in this context, we have 100 plus 50 plus 10 plus 200. So the total is 360,000. This is the capital. So if you are using the proportion of the capital, so the profit sharing will be 100 over 360. This 150 over 360 is 110 over 360 and 200 over 100 divided by 360. This is based on the opening balance of capital.